Look closely at the daily financial headlines. You see constant debates about interest rate cuts, employment metrics, and consumer price indices. The mainstream financial press acts as if these public indicators dictate the absolute trajectory of your wealth. But deep down, you feel that persistent disconnect. The realization that the real forces controlling global capital markets don't operate on public schedules or central bank press conferences. You are told that the Federal Reserve manages the economic cycle with precision, ensuring a smooth path for corporate equities and real estate. But the truth is, you are watching a theater production designed to distract you from the volatile back-end plumbing of the banking grid. Deep within the Federal Reserve's balance sheet lies a silent, structural metric, a hidden quantitative threshold that is rapidly approaching a mathematical breaking point. When this specific trigger is tripped, it will instantly choke off the overnight funding markets, causing asset prices to freeze violently across the globe. If you are managing your capital by looking at standard consumer metrics, you aren't investing. You are walking directly into an institutional liquidity trap. The macroeconomic gears have already turned, and the Federal Reserve's hidden trigger point is closer than you think. To understand the mechanics of the impending freeze, retail investors must first unlearn a foundational myth. The Fed does not print money to stimulate the public economy. It manipulates commercial bank reserves to sustain institutional solvency. It sounds incredibly secure when they phrase it as quantitative easing, doesn't it? It sounds like an endless cushion for your retirement account. But in reality, the entire system depends on a highly volatile mechanism known as the Reverse Repurchase Agreement facility. During periods of massive systemic intervention, the Fed used this facility to absorb excess liquidity from money market funds, building a multi-trillion-dollar buffer. But as the central bank aggressively drains its balance sheet through quantitative tightening, this hidden buffer is being rapidly depleted to keep the primary dealer banks operational. It guarantees that when the RRP pool hits absolute zero, the real structural drain will instantly shift to the commercial banking sector's core reserves. This is the exact moment the invisible plumbing breaks. The moment bank reserves drop below the lowest comfortable level of reserves, a threshold. The Fed openly admits it cannot calculate with certainty. Interbank lending completely locks up. You aren't protected just because your capital sits in an established index fund or a regulated commercial bank. You are completely exposed to the sudden, violent repricing of every financial asset on Earth when the institutional credit engine starves. Let's dissect the historical precedent of this exact structural failure. In September of 2019, the financial world woke up to a catastrophic anomaly. The overnight repo rate, the cost for banks to borrow cash against pristine government collateral, suddenly skyrocketed from 2% to an astonishing 10% in a matter of hours. The interbank market completely froze, forcing the Federal Reserve to launch an emergency overnight intervention to inject hundreds of billions of dollars back into the financial plumbing. This wasn't caused by a geopolitical crisis or a corporate bankruptcy. It was caused because the Fed had miscalculated the minimum reserve requirements of the Tier 1 banking conglomerates, draining liquidity past the hidden trigger point. Today, the structural vulnerability is exponentially higher. Research by leading macroeconomists, including former Fed officials, indicates that the true lowest comfortable reserve level has expanded dramatically due to massive post-pandemic banking regulation. The financial elite call this the liquidity mirage. To insulate your net worth from the next structural breakdown, you must entirely reject traditional diversification frameworks. You need a dedicated counter-cyclical asset layout built on absolute physical settlement and strategic capital isolation. The core defensive shield of this strategy demands that a substantial portion of your liquid net worth is decoupled from the institutional ledger system entirely. This means holding fully allocated, unencumbered physical gold and deep offline cryptographic assets with absolute key isolation. This capital is not deployed to generate speculative yields or trade daily market momentum. It is your sovereign insurance policy. When the interbank funding market chokes, commercial institutions are forced to temporarily restrict capital mobility, freezing withdrawals and implementing strict transaction limits to preserve their own operational reserves. Having your foundational wealth locked outside this digital matrix ensures that your baseline purchasing power remains entirely fluid and actionable while the broader market undergoes a forced deleveraging event. It provides the unshakable, strategic baseline required to move aggressively when asset valuations completely disconnect from reality. Once your sovereign base is fully secured, you view market volatility not as an existential threat, but as the ultimate wealth redistribution engine. When the Fed's hidden trigger point is tripped and the liquidity freeze takes hold, over-leveraged institutional funds will experience immediate, catastrophic margin calls. As famously detailed in classic monetary economics, during a systemic liquidity squeeze, market participants are forced to dump their highest quality assets at deep discounts purely to acquire the cash necessary to survive. This is where the rogue allocator strikes. You deploy your secondary cash reserves directly into deeply mispriced, cash-flowing infrastructure, distressed debt instruments, and high-utility tangible assets that are being dumped by panicking institutional players. You do not catch falling knives during the initial panic. You step in as the ultimate provider of liquidity when the system is starved, acquiring premium generational wealth for pennies on the dollar. This is how real financial dominance is achieved. Not by predicting rate cuts, but by engineering your capital structure to absorb the structural shocks of central bank miscalculations. Realize the massive psychological and strategic advantage this operational framework grants you. While the mainstream investing public is glued to their screens, watching their portfolios rapidly contract and listening to frantic central bank statements promising emergency liquidity injections, you remain completely detached and analytical. Why? Because your survival is already mathematically guaranteed outside the legacy clearing network. You understand the hidden mechanics of the plumbing, you anticipated the exact threshold failure, and your capital is perfectly positioned to harvest the deep value assets left behind by the institutional liquidation cascade. This is how the macroeconomic chess game is truly played. You cannot make bold, rational, highly lucrative investments if your entire net worth is trapped inside the very system that is undergoing a liquidity freeze. By decoupling your financial architecture from traditional dogmas, you turn systemic fragility into your greatest competitive weapon. This profound clarity of execution is precisely what separates the elite rogue allocator from the uneducated crowd that blindly trusts institutional promises of stability. The ultimate secret to mastering this macroeconomic shift does not depend on finding a magical asset class or perfectly timing market tops. It depends entirely on the absolute, unyielding separation of your capital vaults. You never risk your baseline survival assets to chase a short-term, speculative opportunity, and you never allow your investment engine to be compromised by emotional panic or legacy banking dependencies. You treat your financial structure as an elite, autonomous fortress. True economic sovereignty is about building an architectural allocation framework that mechanically forces you to accumulate wealth regardless of how violently the central banking system fractures. You can continue following the outdated, superficial advice broadcasted by corporate media networks and hope the Federal Reserve calculates the reserve requirements perfectly this time. Or you can construct an architecture engineered specifically for the volatile back-end realities of modern global finance. The decision belongs entirely to you. If you are ready to stop playing a rigged game designed to keep your capital trapped as institutional collateral, and you want to master the rogue approach to generational wealth, hit subscribe. Let's build the system.